Great. And while we're waiting to get started, just a disclaimer that this WebEx call is being recorded and may be posted on DOE's website or used internally. If you do not have to wish to have your voice recorded, please do not speak during the call. If you do not wish to have your image recording, please turn off your camera or participate by phone. If you speak during the call or use a video connection, you are presumed to consent to recording and use of your voice and image. We've made it easy. Voice and audio are disabled, but feel free to put questions in the chat.
I think we'll wait one more minute and then we'll get started here so that we make sure we have enough time for all the questions at the end. Okay, we're gonna dive in so that we can make sure we get everybody's questions. Annabelle mentioned this at the beginning, but please do keep putting your questions in the chat. Those are we're going to use at the end of the webinar. And I'll keep reminding folks throughout the webinar too as they come up. Go ahead and put them in the chat, and we'll field your questions at the end. Okay. Well, good afternoon, everyone. Welcome to our third webinar in the DOE Nonprofit Webinar Series. I'm Gretchen Gigley, Program Lead for the Renew America's Nonprofits Program. And I think this is the one everybody's been waiting for. We've gotten a lot of questions about direct pay, tax credits for nonprofits. It's an exciting one because, this is the first time they've been accessible to the nonprofit community. Huge, for this community. So we're excited to be able to dive into the details around elective pay and other complementary IRA programs, and also really talk about how to prepare and set yourself up for success, in your projects and in this direct pay path. But like I mentioned, most importantly, this is a time for you to ask questions. We've really arrange the webinar to allow for plenty of time at the end. So please do keep the questions coming in the chat, and we'll make sure we'll get to as many of those as possible, and then field some of those through our Q&A on our website after as well. So on today's webinar, we have Alex Kate Halvey. She's from the DOE Office of Policy. We have Dan Bresette, he's from the Environmental and Energy Study Institute, and Ben Evans from the U.S. Green Building Council. Okay, next slide. Oops, sorry, I didn't say next slide. Can you skip a few? Yeah, there we go. Thank you so much, Mariah. So we've been, like I said, talking about this road to solar, and this is the third in this series. We started with energy efficiency because, we really do feel like it starts with efficiency, understanding, identifying, and prioritizing energy efficiency improvements in your building helps you down the road right-size your solar installation and making it more efficient and effective for your building. So here we are. We started with efficiency. The second one was talking a little bit about assessments, financing, right-size installation, and you can see the links there. I do encourage everyone, if you miss those two, to go check them out. There's a separate set of resources to help you again along this path. But today we're gonna dive into direct pay, and it's the next natural step. Next slide. Okay, so this, as we all know, it's the first time it's been accessible to the nonprofit sector. And it's just such an exciting opportunity to advance your building from energy efficiency upgrades now to energy production. So I'm gonna not dive into the details because we have the experts on the call, and I'm gonna go ahead and pass it off to Alex Kate to get into it. Alex Kate?
Thank you, and thank you so much for that introduction. Very excited to be here and talk about this tremendous opportunity. Um, we'll spend about 15 to 20 minutes here going through the details of elective pay as a program, the process of how to claim it, what kinds of projects and entities are eligible. And as was mentioned, we'll have plenty of time for questions at the end after my co-panelists speak as well. So this slide just gives a general overview of what elective pay looks like. It's an opportunity for nonprofits as well as governmental entities to take advantage of tax credits that have traditionally not been available to folks without any tax liability. And those entities will be able to claim the tax credit through filing a tax return and then receive a cash payment for its full value. In this example, we see a $1 million eligible clean energy project receiving a 30% investment tax credit in the form of a $300,000 direct cash payment from the IRS. Next slide. And actually, we can go to, there we go. The first thing I have to say getting started is to provide a disclaimer that this session is not itself tax guidance. DOE cannot provide tax guidance, but we do want to provide an overview of the program based on regulations on irs.gov that the IRS has put out. So I recommend that you refer to detailed IRS guidance for more information following this presentation. And where there are opportunities to provide comment on specific regulations, please feel free to do so. You can go to the next slide. Elective pay overall is part of the Inflation Reduction Act, which was an absolutely monumental investment in clean energy and climate change. But within that bill, over 70% of the funding is being provided to entities and to communities in the form of tax credits. Because of that, elective pay is extremely important because it provides folks, like I mentioned, like nonprofits, and state and local governments who do not have any tax liability with the opportunity to access these tax credit funds and to access them in the form of a direct cash payment from the IRS. These tax credits can also be combined with other funding opportunities, including DOE grants and loans, other federal grants and loans, non-federal grants and loans, and we'll talk more about what that looks like. And the process here is different than a grant process. It is a tax filing process in which entities complete a pre-filing registration and claim the credit after the project is placed into service. So we'll talk about what that timeline means in detail, but that is a key distinction to make here for elective pay. Next slide. Who is eligible under the regulations? These are now final regulations for eligibility. We're looking at any organization exempt from income tax under sections 501 through 530 of the tax code. That includes all registered 501c3 organizations, 501d religious organizations. There's a long list of examples here, and there are other examples as well. Also, you might see your state and local governments taking advantage of elective pay or providing more information. They are eligible as well, alongside tribes and tribal government entities and public power utilities. So there's a lot of folks here that are eligible, and it includes a pretty inclusive, enormous range of nonprofit organizations. Next slide. One important flag is that partnerships are not eligible for elective pay, even if all partners would independently be eligible. Folks that aren't eligible for elective pay, including partnerships, are eligible for transferability, which is another mechanism to receive a tax credit. But we're not going to get into that as much today, but you can look up more information. But I will flag that some joint ownership arrangements can elect to be treated to receive elective pay for their share in a property. So there's some detailed mechanics here and a link at the bottom of the slide that you'll be provided to look at more details about that in the regulations. Next slide. Which tax credits are eligible? So 12 of the Inflation Reduction Act clean energy tax credits are eligible for elective pay. And this covers an enormously broad range of clean energy technologies. The ITC or investment tax credit and production tax credit or PTC both cover a large number of clean energy technologies, including solar, wind, marine energy, geothermal, as well as storage and technologies like microgrid controllers. So projects under the investment tax credit could include both a solar system, storage to support it, and the microgrid controllers to link everything together. So there's a lot of range covered here, but it also covers key vehicle and EV charger tax credits, sections 45W and 30C. The 45W credit provides tax credits for clean vehicles. And the EV charging credit, section 30C, which we'll talk about a little bit more later in the presentation, covers chargers that are installed in low income or non-urban areas, and there's a map available. So really a huge range of technologies available here. So whether you're already have clean energy projects in the pipeline for your organization and you're looking for funding mechanisms to support them, these tax credits are a tremendous opportunity. But also it's important to recognize that through the Inflation Reduction Act, these tax credits are in statute for the next decade. And so provide an opportunity really for advanced planning as well. So whatever stage that you're at in your organization and looking towards clean energy development, there's really an opportunity provided here to take advantage of this new opportunity. Next slide. So what does that process look like? This is a key part of planning as well, because as I mentioned earlier, it's much different than a grant application process with which you guys might be more familiar. Key up front is to identify not only the project that you want to pursue, but the tax credit that corresponds with that project. And that's just to make sure that you can follow all of the eligibility guidelines throughout the process of designing and completing your project. But really the process of claiming a tax credit through elective pay does not begin until after the project is complete. So once a project is complete, your organization will complete a pre-filing registration with the IRS. The link is on this slide. It's also easy to find online. And there's a detailed user guide available to walk you through that pre-filing registration process, which will provide you with a registration number. The registration number is what you will use and submit with your tax return filed by the due date for your organization. And we'll talk about some of those dates. And using the appropriate forms, both for the return and for the specific credit that you want to claim. And the payment will be received after the return is processed. So the earliest possible date of payment is the due date of the tax return of the year in which the project was placed into service, so delivering electricity or otherwise fully functioning. So yes, this is money that comes back after the completion of the project, after the submission of the return and processing by the IRS. Let's go to next slide. So an example of what this timeline could look like, there's a lot of variance here depending on the tax year structure of your organization. But this example is for a nonprofit using a calendar year as their tax year. That's an opportunity available for any organization that has not previously filed a tax return. You can choose a calendar year basis for your return, or you can choose the tax year that follows your accounting year. But in this example, using a calendar year, the deadline to file the tax return for a nonprofit organization would be May 15th of the following year after the project was placed into service. For entities where that deadline just passed for 2023 projects, if you requested a return, it would have been automatically granted, requested an extension, it would have automatically been granted for 6 months to November of this year. That possibility of requesting an extension is available for future years as well. But generally, the tax return is going to be due 5 months after the end of your tax year. Excuse me. Once the return is processed, you'll receive the payment. Important to recognize, next slide is fine, thanks, how these tax credits differ from DOE grants. And this first bullet is a big one, that tax credits are generally not competitively awarded. The generally and the asterisk here to refer to the Advanced Energy Project Credit and the Low Income Communities Bonus, which we'll talk about in more detail, which both have an allocation cap and an application process. But the remainder of these credits have no application process, no competition, no limit on the amount of funds that can be dispersed through these mechanisms. All you have to do is to meet the requirements of the program and correctly submit your return, and your funds will be granted. So really a solid amount of assurance here. And again, these credits are in statute for the next 10 years. So a lot of opportunity for funding to go out. Also great to recognize that tax credits can be combined with other sources of federal assistance. It's an important part of the financing process to look at those opportunities as well, and we'll talk about what that looks like. And then lastly, again, to note that tax credits are earned after the project is complete. This is a difference from the grant structure that can cause some difficulty, but again, a lot of opportunity provided by the first two bullets here and the sheer amount of funds that are available through these mechanisms. Next slide. So I mentioned bonuses, the low-income communities bonus here, but I wanted to take a quick moment to talk through what is a text-heavy slide, but it contains a lot of important information. The first here is a note that there are prevailing wage and apprenticeship requirements associated with these criteria. Generally, most of these credits increase by 5 times when the project meets prevailing wage and apprenticeship criteria, meaning that it paid prevailing wage for the area and used registered apprentices. There's a lot of details available through the Department of Labor and the IRS on what these requirements are specific to your area. But for example, for the ITC or clean electricity investment tax credit, what is a 6% base tax credit increases to a 30% base tax credit just by meeting the prevailing wage and apprenticeship criteria, and making sure that this program helps contribute to good jobs and new opportunities in clean energy in your area. The next 3 items on this chart are bonuses that are available. The first, the Energy Communities bonus, is for projects that are located in energy communities, which is communities that are affected by the transition from traditional fossil fuels to clean energy. So we're looking at communities where coal plants or mines have closed, as well as communities with significant economies based on fossil fuels and now high levels of employment. For both of those eligibility categories, there is a map available on the Energy Communities Bonus webpage online. The third category here is for projects that are located on brownfields, which are sites that are affected by hazardous contamination, and those are assessed and categorized by the EPA. So there are opportunities here as well. Any of those categories would receive a 10% bonus in addition to their tax credit if they're eligible and if they meet prevailing wage and apprenticeship requirements. The low-income communities bonus is for projects that are either located in a low-income community or on Indian land, or that benefit a low-income community or a low-income housing project. There's a lot of details on how those categories are defined on their webpage as well, but this process does require an application. The 2024 round of capacity that is available for this bonus will be open to new applications at the end of the month. So if this is potentially of interest to you and your projects, it's definitely worth looking into. And this credit could result in, depending on your eligibility category, a 10 or 20% bonus. The last here is a domestic content bonus for projects that meet domestic content requirements and can thus receive a 10% tax credit bonus. I should also mention for the low-income communities bonus that applies only to the investment tax credit for clean electricity and not to the production side. So we'll move on to the next slide here just to show you what this could potentially look like. So for a community solar facility costing $1 million that is eligible for all 3 of these bonuses, that project meeting prevailing wage and apprenticeship requirements could potentially receive $700,000 in a direct cash payment from the IRS through Elective Pay and the clean energy tax credits from the IRA. So really tremendous opportunity here with the different bonuses to stack up to a really high value tax credit return. Next slide. I do want to mention here the other impacts of the domestic content requirement. So while meeting domestic content requirements results in a bonus, not meeting domestic content requirements can reduce the base value of your tax credit, and the amount of reduction increases over the years of the program. Projects that are under 1 megawatt, smaller projects, are exempt from this requirement, as well as projects that qualify for one of 2 exceptions shown here on the slide. For 2024, projects that qualify for one of those exceptions can provide a simple attestation form with their return that they meet one of those exemptions in order to receive the full base value of the tax credit. So more information to dive into here, and more guidance came out on the domestic content regulations from the IRS as well last week. So lots to dive into here. Next slide. I also want to highlight the role that grants and forgivable loans can play in funding projects that are taking advantage of these tax credits. It is possible to combine grants and forgivable loans with the tax credit. Doing so will not reduce the basis of calculation for the tax credit. So the tax credit amount that you're eligible for is calculated based on the project cost, whether or not you're claiming using grant or forgivable loan funds as well. With one exception, and that is that the amount of the credit plus the amount of grants or forgivable loans that you're receiving specifically for that project, that's a restricted grant amount is the term that the IRS has defined, that total cannot exceed the cost of the project. Otherwise, the credit would be reduced. And it applies to the credits, the investment tax credits that are listed below. So if we go to the next slide, we can talk a little bit more about what that looks like. So in this example, we see an entity that's received a grant to support a solar installation costing $1 million. If their grant is $1 million and fully funds the project, they won't be able to receive a tax credit because their project is already fully funded. If their grant is $850,000, meaning that the grant plus the $300,000 tax credit would exceed the project cost, the tax credit is reduced to meet the project cost. And then in scenario B, we see that the amount of the grant plus the amount of the tax credit that they're eligible for does not exceed the project cost, so they'll be able to receive the full value of the tax credit. But lots of opportunity here to stack funding across different programs. Question 41, highlighted here also in the elective pay FAQ, provides more detail and examples. Next slide. I also wanted to highlight briefly some incentives provided by the Inflation Reduction Act for energy efficiency. These programs are not eligible for elective pay or transferability. So they're a little bit outside of the scope of what I'm talking about today, but I do want to highlight that they're available. And we'll talk a little bit more about the last item here, the energy efficient commercial buildings deduction, because there was an important change here that makes nonprofits eligible. And I also want to just point out that energy.gov/save provides a lot of important information as well on some of these tax credits. Next slide. And I won't spend a lot of time here because I know one of my co-presenters is going to be sharing more information about this tax deduction as well. This is a tax deduction that was expanded under the Inflation Reduction Act for commercial buildings that achieve specified cost and energy savings. So it's not available via elective pay, but certain tax-exempt entities can now allocate this deduction to the designer of the building or the retrofit. So while folks without tax liability like nonprofits wouldn't be able to take direct advantage of a tax deduction, there is a new mechanism different from elective pay, but similarly that enables those organizations to take advantage of this tax mechanism so that they can be recognized for their improvements to energy efficiency that they've made. I believe that's my last slide.
Yeah, thank you so much, Alex.
Great.
It's always great to hear from the Office of Policy. You all give a very comprehensive overview. And next, we'll be hearing from Ben Evans with the U.S. Green Building Council, more about using elective pay, as well as some complementary programs from IRA, which is in the Inflation Reduction Act.
Yeah, thanks, Annabelle and Gretchen and DOE for doing this. And it's also great to see such a good turnout and all these questions. It's I know we're throwing a lot of information at you, and it looks like the questions are coming in pretty rapid fire. So I will try to go quickly on what I'm going to talk about, and then we can get to some of these good questions in the chat. And there are many of them. I've Ben Evans, I'm the Federal Legislative Director with U.S. Green Building Council. You may know USGBC is the folks behind the LEED green building certification, but we also do public policy advocacy around. We're a nonprofit, a mission-based nonprofit, and we do policy advocacy supporting green buildings policy. And we're pretty heavily involved in working on the Inflation Reduction Act over the years as some of these proposals came together. And I just want to reinforce what Alex Kate talked about in terms of the huge opportunity that this is. I mean, the Inflation Reduction Act, in a lot of ways, not for every building type and not for every technology, but for a lot, has really just sort of turned the economics upside down to where it is, these clean energy technologies, renewable energy, energy efficiency investments are going to be more affordable than the status quo. If your furnace is breaking down, for example, or you're doing a renovation to your building, or you're planning an expansion, you really need to take a look at what what is available and familiarize yourself with what is available. We have a lot of good materials. Obviously, DOE has some good materials. I'm going to highlight some buildings related stuff that we have at the end, but really familiarizing yourself with what's available, because the beauty of the IRA also is that you can take multiple tax incentives. Alex Kate did a great job of highlighting the ITC and how you can kind of, if you got grants and stuff in addition, what you can take. But there's also other tax incentives for other types of technologies that I'm going to talk about in a moment here that you can take alongside. If you're putting, solar panels on your roof, you can take that tax incentive. You can also take a tax incentive for, EV charging infrastructure or equipment, or energy efficiency investments, and all those things can go alongside each other. So it really is a historic opportunity to address building facilities needs, both on the clean energy side and on the energy efficiency side. I think one of the my wife runs an arts education nonprofit here in Baltimore, where I live and then coming to from, and know how much nonprofits need to stretch their dollars. And I will say that these investments also are sort of the gift that keeps on giving in terms of operating costs and energy costs and what you're gonna pay. Yes, there's an upfront investment. These incentives are aimed to help get you over those upfront obstacles, and then the long-term savings are really incredible. And looking at, so just encourage everyone to take when you're looking at this, to take a whole life cycle view of when you're making these decisions about what types of equipment to install. And one of the things we hear, I do a lot of speaking about the IRA, and one of the things we hear from a lot of folks is sort of they don't know where to start, and there's a little bit of inertia around. All of this is so new. It's so much information. I know we're throwing. You guys are nonprofit leaders, and this isn't your normal space, and we're throwing all this information at you, and it's so much to absorb. And I think particularly with the tax incentives, it is incumbent upon you. I think a lot of nonprofits are very accustomed to grants and applying and getting a yes or a no. And then you proceed. I mean, that's not how this works. I mean, this is, it's just sort of like filing your own taxes, where you need to figure out, what's eligible, what kind of things you need to follow, what the rules of the road are, and then file your, your taxes. And I think as a place to start, I would recommend, a lot of the materials that are out there, I think are very good at sort of giving you an idea of what you might want to pursue. And you can drill down on, okay, I want to do solar, I want to do an energy efficiency retrofitting. You can really drill down on those and figure out, okay, this is probably one I want to look really closely at. And that's when, if you're working on a project, talk to your architect, talk to your contractor, talk to other buildings professionals that talk to USGBC. I know that, for example, Lawyers for Good Government and some other environmental groups are going to be setting up a pro bono sort of hotline that people can call to get free, that nonprofit, I should say, entities can call to get free advice around the IRA. That's not set up yet. I think it's starting in July, but keep your eye out for that. So I think there's going to be a lot of information out there. And then also, talk to your tax professional. I mean, one of the things we hear a lot, for example, say university, their finance office says, we've never done this before. We don't take tax incentives. We don't pay tax incentives. We don't pay taxes. We've never filed, tax returns. This is not something we do. And push and say, look, no, these are new opportunities that we can do. And I think that's the way to really get started. It is complicated. It requires some initiative, but I think the payoff is really worth it. Next slide, please. And I'm going to pretty quickly go through these other incentives. And Alex Kate talked about this, is the Section 170 This is for energy efficiency improvements to a commercial building. The bottom line is you can get up to $5 per square foot for meeting certain energy efficiency performance. And that's you can do it for new construction. You have to model it against a model code, or you can do it for existing buildings. If you have an existing building and you're doing a renovation, you can demonstrate that you've improved your energy use intensity and get that same sliding scale. It's $2.50 to $5. And as Alex Kate mentioned, This used to be not available to nonprofits until the IRA. It was available for governments. Governments could access it. And essentially, the way that they could access it is to sign it over to the designer of record for a project. That can be the architect, engineer, or some other contractor who's done the design work on the project. And now nonprofits can do that as well. So even if you don't have tax liability, it's not as simple as the direct pay, but you can sign it over and take advantage of that. And there's a little bit of a cottage industry around 179D that you could tap into. But $5 a square foot in today's construction prices is not, that's not going to pay for your project, obviously, but it can often really help cover the marginal difference between doing it sort of the status quo way versus doing it in a more putting in these energy efficiency improvements when you're doing a renovation. Next slide, please. And this is the section 30C. This is for alternative fuel, mainly for EV charging is how most people think of that. There are other vehicle technologies that apply. Structured very similar to the ITC, where it's a 10% on investment. It is available for direct pay. One of the wrinkles with this one is that starting this year, eligible properties have to be in defined rural or low-income census tract. I have a link on these slides where you can click on the map to find if yours is in there. And we can go to the next slide and I can show you. So on this map, the tan and gray and green census tracts are eligible. The gray will go away after a little bit because I think the census is updated. But you can see a really large swath of the country is covered under this. And so, if this is something, if you're a church or a rec center or something, you've been wanting to put EV charging, getting 30% on your 30% of your investment back is a pretty good deal. Next slide, please. Another thing I just wanted to flag, and I know there were some questions in the chat about, it is true, the tax incentives, because they're tax incentives, not grants, you're going to get them once your project is done and placed into service, right? So you're going to have to be spending, you still have to find the capital to do this, and then you will get your tax, just like in the real world, you get paid and then you pay your taxes and maybe get a refund later. You will get that refund or your direct pay after the project is done, and so there is a lag time. And I think one of the other provisions of the IRA is this greenhouse gas reduction fund. It's a $27 billion fund that is essentially established to build up a national network of nonprofit financial institutions that are doing low-cost lending, below market lending, in some cases forgivable loans and things like that for green projects. And so we don't need to go through all the nuts and bolts here, but the bottom line is there should be a green bank, CDFI, credit union, or something else in your neck of the woods that's going to be doing this type of lending. And if you have a project, particularly a project in a low-income community or disadvantaged community, it would likely be eligible for one of these gap loans, for example, or they'll do traditional long-term financing on projects. Next slide, please. As I mentioned, we have a lot of resources that are specifically related to buildings on our website. If you want to take a look, check that out. And my contact information is on the next slide. And with that, I'll turn it back over to you, Annabelle.
Yeah, thank you so much, Ben. Next slide. Up next, we have Dan from EESI, the Environmental and Energy Study Institute. And this section we're sort of calling putting the pieces and team together. So now that hopefully you understand some of the baseline of elective pay and this tax credit opportunity, this might be a good way to think of some next steps or things you should be aware of.
Thanks, Annabelle, and thanks, Gretchen and Alex, Kate, and Ben for a great set of presentations so far. I'm Dan Bresette. I'm the president of the Environmental and Energy Study Institute, and I know I'm the one standing between us and questions, and I can see the chat too. They're coming in fast and furious, so I'll move pretty quickly, and these slides will obviously be available online, and you can always go back and rewatch the recording as well. So next slide, please, Mariah. So I'd like to just go back to something that was said a couple times a little bit earlier, but that is that, when we're talking about, putting these projects together, I encourage everyone to think very holistically about them. And when you're talking about clean energy investments in buildings, you're really talking about energy efficiency first. And efficiency is a really great thing. As someone who runs a nonprofit not as cool as a nonprofit as Ben's wife does, but as someone who runs a nonprofit, I know that every dollar I waste on my utility bill is a dollar I can't put toward my mission or advancing my goals. And that drives me crazy. There's a little bit of a snafu on this slide, so you'll have to use your little bit of imagination. But the idea is that there should be a plus sign between the light bulb and the sun, and then there should be an equal sign between the sun and some money. And the idea is that the more you invest, thinking holistically, the more you invest in energy efficiency, the less you have to spend on renewable energy. And that means, in combination, the more you get to spend on other good stuff. That's the reason for your nonprofit's existence. There are lots and lots of benefits, but at the end of the day, if you just want to boil it down to money, energy efficiency plus renewable energy is a really, really good combination. It's really always a good thing. On the next slide, like Ben was saying, a lot of information has come at you. And I think it's fair to say that the technologies we're talking about work really well. There's not a lot of technology risk with energy efficiency, renewable energy, electric vehicle charging infrastructure. The financing, the grants, these are programs that have been enacted. They're out there, they're coming together. There's still a little bit of patience involved, I think, in terms of like how this is actually going to go. And, you know, it's maybe a situation where it's hard to be first, but no one ever wants to be second when you're applying for these kinds of incentives. But so those are already there. But really, I think where a lot of the challenge that a lot of nonprofits that are on this call right now will have is how do you take all of these different pieces and put them together in a way that makes sense? On this slide, the orange puzzle piece is Energy Star. It's a great, much like the Department of Energy, it's a tremendous source of information to help you kind of get an idea of what's out there. USGBC has great resources as well. There's a lot of information out there about how these projects can come together, and Energy Star is a great resource. You should also talk to your contractors, your auditors, your architects, others who are involved in the different projects, the developers who might bring solar energy to your facility. But if you flip to the next slide, the remaining puzzle pieces are all, and actually a click too, because I have a little box here. The other ones are really involved with the dollars and cents of it all. And putting these puzzle pieces in a way that makes sense for these projects is tricky. I know a lot of people in the chat are like, oh, I got to get my solar installation done. Yeah, that would be really great. We would love to see solar on every building in the United States, basically. But you have to make sure that that solar project is right-sized. And that's where energy efficiency comes into place. It doesn't make any sense to put a solar project on a roof that's much larger than you need because you're still wasting energy at that point. You're just not paying for it on your monthly bill. You're paying for it in the installation cost. And I know there's a lot of there's a lot of eagerness to think about these things in terms of simple payback, but I encourage everyone to think instead about return on investment. Because what return on investment focuses you on is how to maximize your total savings, how to minimize your total costs. And if you do that, then you end up getting a better return. And when you think holistically, you're also thinking about utility rebates, you're thinking about other grants, whether they're from the Department of Energy, like Renew America's Nonprofits, or if they're maybe from other sources. Your nonprofit also may be able to develop some cash reserves, or maybe you have some cash on hand. Maybe you have a philanthropic partner that would like to help you with this. Ben talked a little bit about the Greenhouse Gas Reduction Fund. There are other sources of financing we'll talk about in a minute. And then obviously tax credits and direct pay, which is the total game changer that everyone has laid it out to be. It really does mean a lot for the nonprofit sector. Adding all of those things up together will help you sort of achieve that higher return on investment by maximizing your savings, minimizing your costs, and when you do the division, you end up with a better number. On the next slide, I want to talk a little bit more about financing very briefly. There's a lot of different financing options that are out there. At least at present, these financing options vary a lot based on where you are. You might live in a place that has a green bank. You might live in a place where there's a community development financial institution that has a specific interest in helping nonprofits with clean energy. You may live in a place with a utility financing programs. There are a lot of different financing options that are out there. And I've really only talked about ones that are either public sector or quasi-public sector. There are commercial ones as well, of course, banks and credit unions and things like that. How do you, for folks in on the webinar right now, you must be asking yourself, how on earth could I possibly orient myself with all of these different financing options? Well, if you click, it just so happens that there is a really, really great resource. Mariah, would you click for me so my animation pop up? And one more. It's called the Financing Navigator. It's part of the Better Building Solutions Center, and it's one of many resources that can help you find opportunities for financing where you live, and based on what's available, it can help point you in the right direction for making the clean energy investment that works better for your nonprofit. And there's the link there. The last slide I have before we turn it over to the questions is the idea of this building a team, right? We all work in organizations. There are multiple people involved. If you're on this webinar right now, I think it's fair to say you could be the purple box, the project champion, the person who is going to be responsible for seeing this project through to the end. But there are a lot of other dynamics in organizations, and the decision-making process, right? Like, it's very easy to say no to something. It's a lot harder to say yes and to see sort of the value for this, especially if your nonprofit is resource constrained and you have competing priorities, and maybe there are folks that you're working with that aren't seeing the value in making a clean energy investment. And so what this slide really gets at is, across your organization, you would probably have to talk to different types of people. And as the project champion, you also have to start learning how to speak different languages. And so when you're talking to your organization's leadership, the leadership is going to be focused on things like the reputation of the organization, whether it's meeting its goals or whether it's delivering on its outcomes, probably development and fundraising, advancement, even recruitment, hiring new people, bringing new people on board. When you talk to your finance folks, they're going to be thinking about, well, is this investment really going to be profitable for us? Is it really going to deliver the savings that's being promised? How does that affect our expenses? And is this the right use of these scarce dollars at this time? For the facilities folks, they're going to love their clean energy investments. They're going to see the resilience benefits of it, potentially the reliability, depending on what kind of line of work your nonprofit is. These kinds of investments might help your facility stay online longer. Maintenance might become easier. People who live and work in the space might have greater satisfaction and feel better about working there. There's obviously a sustainability element to this. For ESI, carbon emissions reductions is number one, but also, reducing your consumption and being able to compare how you're doing against other peers using benchmarking. And then don't overlook the communications aspect of it. Nonprofits that go through this process and make these kinds of investments, they might be able to generate some publicity about it. It might be an opportunity to reach out to stakeholders and raise the profile and really make sure that your organization is getting the credit for making the kinds of investments that we're all talking about. So with that, I'll go ahead and close this out. I think my next slide is just a list. ESI has a lot of resources for nonprofits interested in energy efficiency and solar energy. I'll highlight the fact sheet, Direct Pay for Nonprofits and Tax-Exempt Entities. My colleague Miguel Yanez Barnuevo put that together a couple months ago, and it's a really great one-stop shop resource for orienting yourself for all of these incentives. I'll go ahead and end it there, Annabelle, and turn it back over to you, and hopefully I stayed within my allotted time.
Yeah, thank you all so much. We have about 20 minutes for questions, and we have a lot, so we're excited to get that going. And I'm going to pass it to Gretchen to maybe pitch some questions to our panelists from the chat.
Yeah, thank you, Annabelle, and thanks everyone, all the presenters for the great information. It's a lot, hopefully we can get through most of these questions. I'll just say those that we don't get through, we will try to address via email after this webinar, but let's dive in. I think we've seen this question a few times. This webinar recording and the slide deck will be shared via email with everybody that's attended and registered for this webinar. So that's an easy one. And then I'm going to dive right into a harder one, which, there's a lot of concern over the election and what that will do in terms of impacting this direct pay. And what could a new administration in November cancel the funding in 2025, for instance? So I'm just going to put that out there to the group right away. I think we have probably a half a dozen at least questions around that concern.
Sure, I can jump in because I certainly understand the concern, and a lot of organizations are in the early stage of planning for the years ahead and want to make sure that you're going to continue to have access to this program. I think it's important to realize that these tax credits and elective pay are not just a policy of this administration. They have been enacted into law through the Inflation Reduction Act for the next decade. So overturning those programs would require another act of Congress, another law. We don't feel that there's a particularly high risk of that happening because of the success of these programs and because of the high bar for that type of an act of Congress. So yeah, it's not just a policy put in place by the Biden administration. It's been acted into law and has the stability of an act of Congress for the next 10 years.
Okay, great. Thank you, Alex Kate. I'm just going to power through these because there are quite a number of really great questions. So thank you so much, y'all, for engaging with us in this way. Since nonprofits do not pay income tax, typically, could the elective pay credit come off of payroll taxes?
No. So this is only applicable to income taxes. So your only way to claim these credits is through elective pay, but then you will receive that payment as a direct cash payment, and you'll be able to use those funds however you would like throughout your organization. They're unrestricted funds once you receive them.
That's great. What about K through 12 public schools?
Yep, eligible either as an instrumentality of a state or local government or as a nonprofit, depending on how they're structured. But we've done a lot of outreach to schools and know schools that are planning a lot of projects under elective pay.
And I'll just
flag that there's you were probably about to say the same thing, Gretchen.
go ahead, Ben. Go.
Just a really, DOE did a really good webinar, particularly focused on schools and tax credits. And particularly on ITC, which is posted, I think, on the Renew America Schools website, correct?
That's right. Yep. And we do have another one coming up that's a deeper dive. And I believe one of my colleagues put the registration in the chat. If not, if y'all could add that. And that's at the end of this month. So encourage folks to check it out if you're working at a K through 12 public school or with the school. To get more detail. Let's see. This is on generation of electricity. Does this apply to changing a church to geothermal from gas?
So geothermal and geothermal heat pump technologies are eligible. Definitely dive into the IRS FAQ and regulations for the full list of technologies and any requirements. But yes, geothermal technologies are eligible.
Great.
And I would add that just anecdotally, what we're hearing from the market is that geothermal is particularly well positioned to do. I mean, obviously, it's a more expensive upfront investment, but typically geothermal, from my understanding, is qualifying for the domestic content bonus. So you're looking at least a 40%. And then, if you're depending on where you are and some other things, we might qualify for some of the other bonuses. So it seems like geothermal is a much more attractive option with the IRA, with the ITC.
Great, thank you. There are a lot of questions around the transfer of credits and, when you have multiple parties involved. So I'm going to try to address some of those. Can the solar developer / project financier take the ITC and or PTC and the local government entity simultaneously take credit for the direct payment for the same project?
No.
It's sort of an overlap. Okay.
So the credit can be claimed only by the owner of the eligible credit property. So not necessarily the land or the building, although those often go together, but whomever owns the credit property that is eligible for the credit is the entity that can claim it and the only entity that can claim it. And I'll also note, because I think there have been some questions related to this, that ownership needs to be maintained for 5 years. And so the credit would be subject to recapture for a portion of it if the property is sold before that 5-year period.
Okay, great. Thank you, Alex Kate. Is there a limit to how many times an organization can file for credits?
Nope. You can do as many projects as you like and continue to claim the credit.
Okay. Do these tax credits apply for solar installations that were donated by a third party?
I don't believe so because they wouldn't have any project cost. But I'm not exactly sure what that would look like. It's possible that the organization that did pay for them could themselves claim the credit, maintain ownership for the correct amount of time, and then donate it. That's a little bit, I think, different though than what you're asking.
Okay. Let's see. Do these tax credits cover infrastructure upgrades that lead to installing EV chargers? So any kind of the infrastructure changes in order to, made to install the EV chargers?
Broadly, no, they only cover the charger property that's like directly a part of that project. But again, recommend that folks get into the regulations for the specific credits because it clearly helps to outline more of what projects are available.
Alex, has the final guidance been put out on that, on the 30C, what qualifies as the eligible investment?
No.
Yeah, I didn't think so. So there's sort of an open question there, right, about what exactly qualifies.
Yeah.
I would also recommend that something that often utilities might have incentives for. I know we work with a lot of utilities in rural areas, electric cooperatives, for example, and a lot of them have really great EV programs. The ones I'm mostly familiar with are residential, but often they're residential and small business, and a lot of small business programs serve nonprofit customers as well. So that might be an opportunity to leverage what you can get with direct pay with sources of non-federal incentives like your local distribution utility.
And Alex, Kate, this is sort of related, but I think there's a couple of questions there about we also get questions a lot about the infrastructure of a ground source heat pump system, for example. Does the piping qualify? Does the design of our understanding is yes, it does, but it's a pretty flexible interpretation of what qualifies. I don't know if you wanted to touch on that a little more, Alex, Kate. Like for these projects, I believe the intent is to have a pretty broad interpretation of what is covered.
Sure. Yeah, I don't really have more information to dive into that beyond what's available already from IRS. So yeah, I'm not gonna go beyond those credit specifics.
Right. Well, this one is about if the nonprofit rents the property and pays for the property or the project, does the tenant nonprofit or the owner nonprofit receive the tax credit?
It's the owner of the clean energy installation itself.
Yeah.
So for example, if the building is rented, but you're putting rooftop solar on it, it's the entity that owns that rooftop solar system.
Okay. That makes sense. And then you had addressed the 5-year rule is the 5-year rule still in place? So I think we've addressed that one. In geothermal, there's a lot of interest in geothermal also, which is really exciting. If my project is partially paid in 1 year and completed in the next, do I submit 2 tax credit requests for the amount spent in each year?
It's a good question. So you'll wait until the entire project is complete and placed into service, and then you will file for a credit against the full cost of the project, even if it was paid out over multiple years in the year in which it was placed into service. So you'll only file one time for each project, even if it took multiple years to complete.
Okay, got it. Thank you. And then this is a timing question. Is there any idea on how much time the IRS will take to process these tax filings made by May 15th? Our nonprofit will be financing the money to be returned months in advance of its payment. So it's that gap funding kind of, question.
Sure, and it's an important question, and it's one that IRS is working on. They have not released any specific information yet on what that timeline will look like, but they have put out sort of an acknowledgement of that people want to know and that they're working on figuring out what that's going to look like. The first round of tax returns that we're requesting tax credits through elective pay are just coming in this week. So I think as we go forward, we'll start to hear anecdotally and also from IRS more about what exactly that timeline will look like.
Okay, great. And then this is a clarification on what does the project being done mean complete or active/commissioned? So it's
Sure. So
yeah,
the official term is placed into service.
Okay.
So actively generating is a good metric, but there are details depending on the technology that are available.
Okay. We may have dealt with this one, but if a partnership sells their credits for cash, would the entity that's purchasing them be allowed to pay cash before filing the tax forms? And would the nonprofit need to file forms as well?
Sure. So I believe this is a question about transferability, which is a
Yeah.
different mechanism than what we've really talked about here. So partnerships, which are not eligible for elective pay, are eligible for transferability, as the question mentioned, to sell their credit to a third party for cash. There are form filing requirements for both the buyer and the seller of those credits. I think the question is whether they can use the money they get from the third party before that they've officially filed. I believe that you can, but I will note that for transferability, the owner of the project, the seller of the credit, is the entity that would be on the hook for recapture in an event that the credit was filed incorrectly. So I think there's some organizational liability to consider there. But again, we haven't fully dove into the topic of transferability. There's a lot more information that's available through IRS resources.
Okay, great. Thank you. We're in the last couple minutes here, so I'm going to try to make my way down. I think there's some questions around clarification on tax filing because nonprofits only file 990s. Is that what they would use then, to file for their tax credits here?
Yes, that's correct.
Okay.
And if you're already filing a 990T for another reason, you'll continue on the same tax year and filing deadline, but be adding on credit forms that are associated with the credits that you're claiming. And there's a lot of detail available on the IRS webpage about what those forms are and guidance for filing each form.
Okay. I think I'm
And I just saw a question come in on if you've never filed a 990T, that's also fine. If it's your first time filing, you can choose a tax year that either follows the accounting year of your organization or a calendar year basis, and that'll determine your deadline, your filing deadline. So again, recommend jumping into the IRS Elective Pay page for more information. But yeah, even if it's your first time filing, you can.
Okay.
Great.
Great.
Well,
Thank
hopefully,
you
I
so
know we don't
much.
have time for every single question, but hopefully that was a good overview. And thank you to our speakers for answering great questions. If we go over to the next slide, we do want to provide some links to find more information, perhaps find the answer to your question or ask a question. All of these links are IRS or DOE websites, so hopefully you can find your answers there. Next slide. We also have resources we want to keep sharing. As Gretchen noted, this is a 3-part series. So we shared some great things about energy efficiency, about solar, and overall in every webinar, we try to touch on financing, including of course here with direct pay. So these are some key links we would really recommend checking out. Next slide. Before we go, we do always just want to give a shout out to our upcoming webinars. We really enjoy speaking with this nonprofit audience and are really happy to be able to engage with you all. So there is more coming soon. Our program is working actively to support nonprofits nationwide. We encourage you, if you're not already, to sign up for updates. We do have a monthly newsletter, among other information going out. Be on the lookout, our next webinar about community solar. And we encourage you to give us feedback and let us know what your needs are or what other webinars you're looking to see, or maybe there's a part of this you want expounded on. So again, please visit our website for more information, and as well as our partner website, Renew America Schools. They're doing lots of webinars as well. And as Gretchen said, slides and recording will be shared after this. Thank you so much, everyone, for coming. And thanks again to our panelists. This was definitely a lot of information and a great webinar. Really appreciate it.
Thank you, everyone. Appreciate
Thank you.
it.
Thank you. Good luck.